Are you worried that we're expecting too much from U.S. growth?
We are pretty optimistic and constructive, as you say, Francine. And yes, thank you for having me on. If we are correct, this week we're going to see the 7th consecutive quarter of above-trend growth in the U.S. So when we get that PCE data later this week. And I think two things we've realized about the U.S. economy in the last 12 months. One, population growth or immigration has surprised to the top side. We are now seeing immigrants entering the U.S. on the order of 300K per month, whereas the forecasts were less than half of that about 12 months ago. So that's been a positive boost to the labor market. And the second is the resilience of the consumer. I would even call it a robust consumer outlook. And so we've been positively surprised on the growth front. And for us, that's a very constructive environment for risk-taking. We have a preference for both U.S. equities as well as credit markets, given this view that recession risk is pretty low and actually moderating further, and growth is very robust.
So, Thushka, what does that mean on how you're constructive on portfolio? I know you're pretty overweight actually on credit. How long does that remain for?
Well, essentially we're of the view that we're seeing an extension of the U.S. cycle. We prefer carry, as you mentioned, high-quality parts of high yield, the shorter end of the credit spectrum. What's been interesting in the last, let's say, 3 to 4 months is even though issuance has picked up in this space, we've seen very strong demand. And the second is even as default rates rose at the end of last year, spreads continue to tighten. And this is partly a structural point, but also we're seeing it play out cyclically, where the average credit quality, the median credit quality in high yield is now a much higher quality than it was previously. So it's on average double B instead of single B. And that's now helping that market stay resilient.
Thushka, I know there's been quite a lot of thoughts on repricing, given what we heard from the Fed. I've been spending quite a lot of time trying to find R+, and I know you've been spending quite a lot of time looking at the neutral rate. What does that suggest in terms of what the Fed does in 2024 this year and then beyond?
Yeah, Francine, that definitely is a question in motion at this point. We had previously expected the Fed to be delivering between 2 and 3 cuts this year, starting in the middle of the year. I'd say that's now moved to 1 to 2 cuts. And I think, as you say, the question is about the timing of when they start easing, but also where do they end up? And our view is that, yes, they could start cutting rates purely as inflation moderates further, but it's uncertain. And the terminal rate has shifted higher. Markets are now pricing the terminal rate 2 years forward around 4%. That was previously around 3.5%. So it has moved up in market terms. The Fed long-term dot at 2.5% still looks too low to us. But it is fair to say that the near-term R-star measure has moved higher. Very hard to put a number on it. But this is very positive for us, both in terms of growth, but also in terms of the equity market or risk market outlook.